Alright, we're going to go ahead and hit you with a good old Options 101. We're going to learn about options, how to trade options, what the heck are options. First, obviously, thanks to my best buddy there in the comments there, telling me he wanted to see this trade and he wanted to learn a little bit more about options. So, guess what? So, I did a no-no here and I bought options on a penny stock. That's right, it's a no-no, and we'll get into that in a little bit. But just as an example here, so I bought this fuel cell $1.50 put that expired February 21st, and I've already sold out of it, as you can see. So I bought this bad boy for 35 cents for the contract, and basically, if you think about it from a options perspective, that 35 cents is actually times 100 because you're really playing around with 100 shares of stock. So anytime you're investing in options, that contract price is actually going to be for 100 shares of stock. So that 35 cents is actually $35, and I ended up selling it actually the next day. Not something I advise, but I sold it the next day for 45 cents for that contract. So $45 sold on that. Because the bad boy was up and I was slightly afraid. And that's the thing about these penny stock options, especially put options. You can definitely find a time where you get a little bit scared to let it ride. And I'm glad I did make this decision because fuel cell, if you noticed, the stock is right back up to where it was when I purchased that put. And then it fell down pretty significantly for a day, so that's when I bought this put option. And then I sold it, and the thing's back up, so I'm glad I made the sale. I'm not saying that I couldn't have made more. I think there's potential because that's why I bought an expiration date in February 21st specifically, but it's okay. So we're going to take a look at options. Obviously, you have two different things you can do with options. We're just looking at Apple here. In my opinion, I don't even play around with this sell category here. I'm more concerned with buying calls, buying puts. Just really mess around with buying. I think it's the best option, and I think it's the best chance. If you actually want to get in options, you should be only really messing with buying calls or buying puts. So, what is a call option? A call option is pretty well you're putting your money down, saying that you believe you can make money because you believe this stock is going to be at least this price by the given date. If we look here on the expiring page here, obviously there's options made out for all the time. I mean, you have options, you have long-term options, so some year out, and you have some short-term options as well, which are a couple weeks, a couple months out even. So you have shorter term and you have longer term options. So there's plenty of opportunity there for buying and selling these. With puts, it's the same exact deal. So puts, you're believing that this stock is going to get under this price by this given time. So you think this thing's going to fall by a given time. And with a call option, you are going to go ahead and buy the stock. You're giving yourself the opportunity. That contract is reserving you 100 shares of that stock at this given price. So that's why you pay the cost of the contract, which is the premium. So here on the right-hand side under this price is the premium you pay for this stock or for this option. So you're going to pay an extra $6.10 per share for 100 shares for this put option here. Obviously, this is not a good put option because it's beyond the price already, so it's a guaranteed. I mean, not much going on there, but if it goes down, you could potentially make some money, but still. So you're paying an extra $605, right, to assure yourself 100 shares of Apple at $302.50. You know what I mean? So that's fantastic, right? So you can definitely be able on a put option to sell at that strike price, and you could pay less for the stock. And you get the same thing with call options, really. So if you think this stock's going to 305 and you pay this premium of $1.68 per share for 100 shares, obviously 170 extra dollars. So even if Apple stock gets its way to 310, you're still getting the shares for 305 because that's what your contract option was. That's why you paid that premium, so that you could actually benefit for the stock going up. Now, that's actually using options in their intended way. The more risky way is actually buying and selling the options too. So you can obviously sell, as I did with my fuel cell put. You can sell your options. So if you believe it's a lot more volatile than normal stock. So pretty much if you choose a tame stock, the options are going to be a lot more volatile on it, and that's just really how it is. Nothing too absurd. Just it's a lot of volatility, and it's a lot of risk too. The biggest risk, obviously, with options is the fact that you have the chance to lose all of your money. You certainly do. So in this case, let's say we said by the end of January we believe Apple stock's at 305, right? So you pay this premium for this contract. If Apple does not reach that strike price, you're completely out of your money. Okay? You're completely out of your money. If you don't sell that option off prior, at least. So if you ride it out because you think it's still going to get there and it doesn't, this contract expires completely worthless and you're out of all of that money. So in this case, that's right. In this case, a lot of money, $773, right? Now, what are the chances of that? So that's why I chose Apple stock. You'll see a lot higher, really a lot higher equity on these, because not only is the share price higher, that's not necessarily it. It's because it's such a more trustworthy company. So if we want to look, in my opinion, I would say let's look January 2021. So we're going to say a full year has gone by. A lot of people are having price targets around 300. Right now, this thing's already around 300. So let's say I believe Apple stock is going to end up going to $320 by January of 2021. So this contract is long-term options are obviously more expensive because there's a lot higher potential for success here. So one important thing to look at, obviously, is going to be the Greeks. That's right. And to give a little bit of a just explanation on the Greeks here, I think Investopedia's got a great little explanation here. So delta can be thought as probability. For instance, 30 delta option has a roughly 30% chance of expiring in the money being successful. So the higher the delta, the higher the chance of you actually having benefiting from that contract. Gamma, it's the speed of the option is moving in and out of the money. Gamma can be thought of as the move of the delta. Okay. Vega is the Greek value that indicates the amount by which the price of the options would be expected to change based on 1 point change in implied volatility. Okay. And then how about the theta is the Greek value that indicates how much value an option will lose with the passage of 1 day's time at that current price. So how much money, how much value could you lose is this Vega. That's right. Could be, it's not all that much, not all that high. So you see it obviously differs depending on that. So obviously your price for a contract for 300 is obviously a lot cheaper, but your delta is a lot higher because there's a lot higher potential that this will be a successful dealio going on here. So implied volatility is also something good to look at. Obviously, there's a lot of volatility with it already. Nothing crazy, but for sure, definitely you need to keep an eye on delta, and it depends for a couple reasons. So if you look at more, let's say, volatile stocks like a Kronos company, a Mary Jane Company, and we're looking at a January 2021, and we say this thing's going to $10 a share, which is obviously a lot higher of a price change. 61% that this stock has to go up to actually break even. You get a delta of 42, right? So a lesser chance, really, just because how volatile this thing is, but it also has to go up quite a bit to reach that. But this contract is obviously a lot cheaper. And you'll notice as you go further and further up in these prices, these things get a lot cheaper. And there's for good reason, because if you're looking, you're crazy, man. You think Cronos is going to $30 next year. The delta is 5, right? So you have there's a 5% chance technically that you could actually get value out of this contract right here. Yikers, that's all I can say. That's all I can really say. Don't definitely look at the delta. The delta is important. Implied volatility of 72%. Don't just going off of a whim. But that's the main thing with options, is the fact that really it's going to be based off of a lot of research. You need to do a lot of research if you're going to do options. So if there's actually valid justification that you believe that Cronos is going to reach $30 a share, because you've done the math, you've done everything, you know this, you think this stock's going to go up 340% in a year, which is absurd. But it could, you never know. Weed stocks they're in. You could get a lot of value from this. Not only just letting it expire and getting those shares of that value at that price, you could also sell off that contract later down the road, and it's a very good way to make more money with less money. I don't want to advise it because of the fact that there's also the risk of losing a lot more money. So that volatility means this price could be significantly changed for that. Because if you think about it, 9 cents a contract, really, it's only $9, but that $9 could turn into $18. That $9 could turn into $0 just as easy. Because if no one's willing to buy that contract off you and you don't want it anymore, you're stuck with it. And if you don't reach that value, it's expiring worthless. Sorry. Just sorry. Sorry, not sorry. So when you're messing with options, just consider, I wouldn't personally put much money that I'm willing to just completely get rid of, because it's in essence gambling in the market. Now, I don't necessarily believe that all options are 100% gambling, but it's the closest thing you get to gambling in the stock market. Now, the actual gambling would be buying options for penny stocks, as I did, and that's why it's a no-no, because you don't know what's going to bring those up or down. There could be no news and the thing could fall 80%. There could be no news, the thing goes up 80%. That's just the volatility that you see in penny stocks sometimes. So that's why you don't mess with options on them. If you're going to get involved in options, usually choose companies that you've done a lot of research into, that you know the value. So if you are going to mess with, I think there's a lot of money that you could make in options of biopharmacy companies. If you know that they have a drug coming up that's going through a test, you might be able to see if you buy a call option because you think that drug's going to be successful in that study, this stock's probably going to go up. So you could definitely make a lot of money in that way. If you think it's going to go down, you could buy a put option, and it can go that way. And it's a similar thing with stock earnings too. So if you think someone's going to post a really good earnings, you can go ahead and buy an option, a call option. And I hate it because I don't like short-term call options either. I like long-term, because long-term you get the best chance of success, and that's why the price of the contracts are more expensive. But long-term are a lot more safe. But if you wanted to do a short-term one playing on earnings, you could make a lot of money. Could. You also could lose all of your money because that's a short-term option. If you bought long-term, if the stock goes down 10%, there's still possibility that that stock can recover. But if you bought it short-term and you only have a week to gain 20%, it's impossible. If you bought it a year out and you have a year to gain 20% on that stock from where it fell, it's absolutely a possibility. So that's a brief rundown of options there. I know I probably missed some things because there's a lot to talk about with options. In my opinion, I'm not a huge fan of options. I don't personally trade options that often. When I do, it's on a company that I believe is going to rebound either positively or negatively, and I tend to buy them maybe the strike price or the expiry date maybe 1 or 2 months down the road, seeing if I could get that thing on a bounce back potentially. And I tend to always sell the contracts as well, so I'm always selling my contracts. So that's really all I got for options on this one. If you got any more questions, let me know. I can show you some previous options trades I've done. I haven't been super profitable with a lot of options trades. A lot I've just traded it just flat, just because sometimes you get a little scared when it comes to these higher value ones. When it comes to money, you don't like losing it. But options, you know what? You can make money, you can lose money. I like buying just normal stock, thank you very much. So I'm more of a normal stock kind of guy. But to each their own is what I might say. Thank you.